The objective of the Hedged Income Index ETF is to produce a graph that looks like this, with no backtracking. And all it is small, consistent monthly returns through derivative hedges that beat the historic average. This isn't a home run hitter. These are returns targeted for 1% a month. There are risks for this strategy. A monthly income is low, it's targeted at just 1%. If the market falls more than 5% during the holding period, the best case return is targeted at 0%, because the resources will go into defense instead of offense, because we absolutely don't want to experience or suffer backtracking. If the market falls very fast or gaps down overnight, stop losses may engage, liquidating the investment position, possibly at a loss. I'll explain the stop losses in 2 slides. And the hedges that are used are partial. There are 100% full hedges, but those are expensive. This is a partial hedge strategy, and the nice thing about it, it doesn't cost you anything to be the beneficiary of the hedge. The rewards include consistent monthly income. Income is instant. You don't have to wait for the income. You get it up front. You can use it to leverage the return yield or buy additional shares of an index ETF. But you get it up front, and you can do what you want with it up front. You don't have to wait for it. Hedges are used. That's very important because mutual funds don't hedge. There's zero to little backtracking for those reasons, and there are multiple forms of growth. There's derivative income from the sale of the derivatives. There's dividend income from the ETFs. There's abatement of loss. Consider it a penny saved, a penny earned. There's share quantity growth. You can purchase more shares with the derivative income if that's what you wish to do. And there's share quantity appreciation. So those shares that you've purchased are going to grow as the market moves up. This is how gapping down works against an investment or position. Say that the investment plan calls for the stop loss to be applied at where the red line is, and the next morning the investment or position market price opens below that red line, as it does in the example. That's a gap down, and the result is that the stop loss will be triggered, selling the investment or position at the market or possibly a limit price for a loss greater than expected. This could happen. The hedges used are only partial, not full. Full hedges are very expensive, with the majority of their power never being used. Partial hedges, when structured properly, are free. I'll say it again. Partial hedges, when structured properly, are indeed free. That's the power of derivatives. Partial hedges are established at statistically significant points, providing protection to that point, the hedge point. Beyond the hedge point, the position loses money, or the hedge has to be reset. Resetting the hedge is the all-time best-kept secret of good professional fund managers. And very soon you'll have that secret too, in keeping with the hedge strategy's mission of leveling the playing field for the common American. The value of a partial hedge is that technical indicators and component variables of the derivatives to be used provide the answer to how much of a protective hedge will the position need. Those answers can be found within the derivatives themselves. And you can also use other indicators to help. In its basic form, there are just 2 steps to this strategy. The first is to sell an index ETF call option for derivative income. And the second is to buy an index ETF as a hedge for that sold call option. Within those steps are the details, which include calculating the loss probabilities, reviewing the market conditions, timing the entry, setting the stop loss, monitoring it daily, if needed, resetting the hedge and stop loss, and investing derivative income when appropriate. There are rules that must absolutely be followed. Something bad could happen if you don't follow the rules and you go on your hunches instead of following the investing plan. Profits are made only through a sale, never a purchase. That's rule number 1, and that's the truth. You only make money if you have something to sell. Trade only diversified instruments with high levels of trading volume. That's why index ETFs are being used. Those have the highest levels of trading volume. Never deviate from the guideposts or the maps or the rules for determining the depth of the hedge, the stop loss percentage, the derivative income investment time frame, and when to reset and if you should reset the hedge. To explain this further, let's take a look at a visualization. The call option that's being sold gives someone the right to buy our ETF from us at $84. And for that benefit, the person who buys our call option for $6.31 is going to overpay for it by $1.03. And that $1.03 overpayment is our instant profit. And if needed, it can be applied to the downside to extend our hedge protection of the ETF down past 84 to 82.97. 82.97 is our hedge point. If the ETF moves below that because the market falls, money is lost. To remedy that, the hedge must be reset. If the ETF price closes above 84 at the expiration of this call option, we realize our total expected profit. If it closes below 84 to the 82.97 hedge point, we realize partial profit. This is the spreadsheet of the results. Dividends were not paid by this ETF for the time period of the position. Derivative income for these 3 weeks was 1.15%. For the sake of simplicity in this example, derivative income was applied to boost the strategy yield from 1.15 to 1.24% and surpassing the 1% target return goal. In comparison to the buy and hold strategy, buy and hold was the winner this time with a 5.43% result. This second example is for the skeptics who are thinking, but you time the market so the hedge won't be tested as the market rose. Not the case here. The position is engaged at the trend's peak, immediately testing the strength of the hedge. Another visualization for you. The current market price of this ETF is 92.70. The call option is sold for $2.79. The hedge point is $89.91 on this ETF. So after a few days, this hedge is immediately tested, and it turns out that we'll need to reset this hedge because the price of the ETF falls below the original hedge point and is now 89.81. So the first call option was purchased back from the market at a profit. That was realized, but not full profit because of the lag of the hedge. And the second call option, for the purpose of extending the hedge, was sold for $1.73. And that's times 100 shares, so you ended up pocketing $173. There's a 100 share multiplier on options, remember that. To review, let's talk about the process of resetting the hedge to protect our portfolio and how that works. The next strategy is a more aggressive strategy. This is the hedged short condor.